Anyway, I just want to say welcome, and I also want to welcome Ben. You all know Ben Prade, our partner for Bullhound Capital. Please, an applaud for Ben.
Yeah, okay. Well, welcome everybody. So great to have you here again. I can't believe it's 12 months since we were down in that rubbishy place called Ponte Romano. Now we've upgraded to Per's second house in Marbella. So I hope you're enjoying his hospitality. But as we say, you know, enjoy it. Come, it's your place to hang out. Do whatever you want while you're here. So I'm going to talk to you about the funds, where we stand right now in the market, and I might mention a new fund that's coming around the corner as well, if you give me the opportunity to do so. Okay, so let's get started. Right, so this is the kind of the boring part, the fund update that I usually start with on all the webinars, etc. Maybe I'll just come down here actually. So where do we stand right now? So Fund 3 still doing very solidly, 2.6x. Fund 4, 2.4x. The dotted lines are projections for where these funds will get to. Fund 5, 1.2 at the moment, still taking its time to get going, but there's some really good news in that fund, and the underlying growth in those companies is still super strong. We're predicting it at 2.1, but we think we can get past that. Double Down is another stellar fund sitting in the top quartile of all the rankings out there right now. Very early stage, but already at 1.6. And Fund 6, early days, but already at 1.2. It really is a stellar fund. And so things are looking really healthy across all of these funds, as you can see. The previous closed funds sitting there nicely as well. So one point I wanted to make, one thing we always talk about is, when you're investing in funds like us, it's key to not try and time your investment in a fund that you think is in a good part of the cycle. So what we've found with people who have invested the same amount of money in each fund, and there are many of you that are picking up an IRR that kind of rolls up and builds nicely over time. So you can see since 2013, since we started doing Fund 3, the gross IRR, if you had the same amount of money in each fund, is 30%. Now, on a fund of a regular kind of size that we do, you could probably take off 5 or 6% to get it to a net return. If you compare that to the NASDAQ across the same period, 19%, S&P 500, 12%. So the key is, the message is, invest with us fund after fund. Look at us as a core part of your investment strategy. Allocate wisely into that. It does take time though. So where we have had exits, so these numbers here, this is the invested capital, including any investments that have gone to zero. So you may remember in the older days, we did some earlier stage stuff. We don't do that part of the strategy anymore, but some of those went to zero, as is the nature of early stage investing. So if you take all of those into account, with the ones that we've exited profitably, we're at 3.2x on the money that's been invested there. And here's some of the exits. It takes time in this asset class, it really does. But you last it out, and this is what we want. We want to get to 3x. That is the risk reward we're looking for. A risk associated with 3x and a return associated with 3x. We're not that early stage fund that's going to hit 100x on one company and lose on lots of others. That's not the return we want. That's how all of our funds have ended up nicely in the black, and we build that IRR over time. So let's dig into the funds quickly. Fund 4. The guys talked a little bit earlier. Revolut is now a serious chunk of Fund 4, as is Playtomic. So half of the value in Fund 4 now is Revolut and Playtomic. So these are really going to drive your returns in Fund 4. But what's important, the revenue continues to grow there, 29%. 75% of the companies in this fund are either profitable or fully funded, so they've got enough money to get through to profitability. This fund is doing super well, as you know. Gross return to TVPI is 2.3, and we've got some good news about Revolut coming through. Klarna, of course, you'll have seen the IPO there. Our expectation of share price is 50 to 65. Revolut, we talked about. Playtomic is just a fantastic company the guys were talking about. And Ravenpack also has had a stellar recent quarter and continues to produce new products. It's going to be a fantastic situation. Fund 5, So some of you joined us in Fund V. Fund V has taken longer to get going. It was invested at a time when the market was higher. The key metric, though, is this revenue growth. It continues to grow revenue as a portfolio at 40% per year. So it just takes time to build that up, and that will eventually impact the multiple that we price this fund at. Now, if you look at the composition of this fund, 3 key companies are going to drive the returns. Well, perhaps 4. So Connex is a fantastic company. You may have seen the founders from last year, company from Manchester in the AI space. I can tell you without saying too much, there is some stuff going on with that company right now that could lead to changes in that valuation in the right direction. Klarna, of course, has just had the IPO. Lingo Kids is a recent investment where Hughes joined the board. They've got an amazing partnership that's going to be announced in the next few weeks that'll have a significant impact on that company. And also, if we go to the highlights here, DuckDuckGo, maybe a little bit forgotten, is still a big chunk of this fund, has just had reported 70% year-on-year growth. So people talking about the search space is dead. This is a search company in the privacy search space that's doing super, super well and has an AI product coming through. So again, we're seeing longevity in our investments where companies are doing one thing particularly well and then moving with the times and adding product on according to this AI cycle that's coming through. This fund is super, super good. Mubi has had a 6.7x uplift already. Unfortunately, it's a smaller investment in the fund. But there's lots of good stuff. Whoop also, hopefully there should be some Whoop bands for all of you. We've actually negotiated with Whoop to give you all free Whoop bands, so get those afterwards. You get 3 months free. So help yourself to those afterwards. It is a wonderful product, I must say. And Typeform also pivoting towards this AI wave. So good companies can do that. Good founders can do that. This is a good fund. It's taking time. It's a good fund. So we talked about Revolut. So this is current situation. So this is the Fund IV holding here. This is the Fund V holding here as it stands right now. And as Alon said earlier, Revolut is about to do around at 75 billion. A lot of you have asked me what does that actually mean for the numbers in your portfolios. So that will bring the gross return of Fund IV up to 2.8, the TVPI up to 2.6. Revolut will become a 10x, nearly 11x return in that fund. It's also impacting Fund V. It's a smaller position in Fund V, but it's taking the gross return, the TVPI, that's the most important one, up to 1.2. So there's growth there that's coming from that one. Klarna, you will all be aware, has recently had an IPO. A lot of you have asked me, what does that mean for the investments in Fund IV and Fund V? So I've tried to break it out here for you in a very kind of practical way to see how this will affect the investments in the fund over time. The IPO price was 40. It opened this week at 43. We're predicting it to get to that kind of 50 to 65 range. And as you can see, so what this means is on the holding itself, the return on the actual investment at $40 a share, we're at 2.2. The effect on the fund is to take the cash returned on this fund, which is currently at 0.7. So when we say that, that's say, if you put $1 million in the fund, you've got 700,000 out. That will take it up to 800,000 or 0.8. And as you can see, the share price, we hope, will rise over the next 6 months. We are locked in for 6 months. You can see the impact starting to go across the fund. Fund V, here, of course, you'll see this will probably be our first cash return on Fund V. And hopefully we can get to this kind of range and return 20% of the cash that you invested in Fund V when we exit that position, probably in the new year. People ask me, what are we going to do with Klarna at that point when the lockup comes off? The simple answer is, I'm not sure. If the share price is not where we think it will be, we may hold it for longer. We'll see how we go. But Per and the team are around and can answer questions around that. So, double down portfolio. We'll go through this one quickly. This was a follow-on portfolio, less companies in it. It's doing super, super well, though. For its vintage, it's right at the top of the charts. And Fund VI, this is the new fund that we've done. There has been a slight evolution, I would say, in the strategy between Fund V and Fund VI. Fund V was 22, 23 companies. Fund VI is 11. Now, what we've started to realize, what we're really good at, is getting involved with the companies, using this whole organization to power those companies through in those growth stages. There's lots of good, very early VC investors out there that will help companies hire a CFO or a marketing team. But when these companies need to go global, when they need to get their name out there, when they want to perhaps acquire a competitor, when they want to do a big pre-IPO round, 25 years of history of helping those companies across both sides of our business means that we have a unique set of ingredients to help those companies. We can't do that for 25 companies a fund, so now we do less companies. And as you can see from this one, you can see the development here is that 10 of 11 of these companies, we are now have board representation. And that is us working day in, day out with these companies, thinking about what happens next as a new type of investor that they're adding to their board. We've also co-led or led 10, 11 of those deals. So again, it's us being much more active, not a bystander. You know, we had some good results in investments like Slack or Unity in the past, but we weren't really a critical part of that company's development. But now we're bringing all of our strengths to really power these companies through. That also allows us to de-risk the investment because we're really in there, right? If things start to go wrong, we can get hands-on and really help them. So maybe if you guys want to shout out at any point, I know you guys went through some of these companies already, but isn't some interesting angles. I think what's also happened with this fund is we've become a little bit more deep tech. We've added people like Callum. Maybe Callum, do you just want to introduce yourself?
Yeah, quite a few of you before, but so name's Callum, principal in the team, been here about 4.5 years now. Beforehand, I was doing a PhD at the University of Cambridge, working on semiconductors for quantum applications. So cover a breadth of things around AI, energy, but mainly quantum semiconductors, those areas. So been able to lead and sort of help with the investments in Q Control, which is a great company, quantum infrastructure software. I went through it this morning, and things like D-Matrix, where we were able to lead these rounds, price these rounds, because others didn't really understand the company's space in the value chain. Whereas we could come in, understand it, tell the story, help bring in larger investors, and do successful raises with them.
Yeah, so we've made a point now of hiring deep academic people. So I don't know where Irina is. Maybe Irina can wave at the back. Irina's also from Cambridge. She studied nanotechnologies to PhD level. And I think we've also, we have a daughter of one of our LPs who's joined recently. Where are you? I can't see him. But she has a PhD or studying a PhD in longevity and health. So that's the type of people we're bringing in to cater for this new wave of deep technology. It's a big thing in Europe, and it's a big thing across the world. We still have a little bit of exposure, a core part of our strategy really still is SaaS companies. We like those subscription models, whether that's deep tech or whether that's more traditional SaaS, we still do those. And in this fund, we've already had our first exit, which is Cover Manager, which was acquired or merged with the local competitor in France, which is allowed to return some cash to you guys already in this fund. I think the next fund, Fund VII, will look a lot like this. This is what we want to recreate. This is what we're good at now. This is what we do. 10, 11 companies, very hands-on, slant to deep tech, and these companies have good revenues. So, the AI opportunity. You've heard a lot about this. We're all talking about it at the moment. Lots of talk about it yesterday. Maybe I can take my own spin on it a little bit for you. Boom or bubble? That's what everyone's talking about. I've spoken to a lot of you about it. Is AI just one big bubble? Is it going to go wrong? Well, the answer is we don't know. I'd love to pretend I did know. I'd love to pretend the team knew what was going to happen next, but we don't. But maybe we can talk about what we do know. The change is real. Now, those magical words were uttered by a technology guru by the name of Per Roman on Monday. We were talking about it in the IC, and I thought it was quite a nice way just to talk about the change is real. We're not putting AI back in the box. It is going to be a part of all of our lives. I can see the way my kids embrace it, especially when they're trying to do homework. It's going to be everything we do going forward. So the question is, do you want to be in it? There will be great successes, we know that, and there will be great failures. And that's why we want to be your guide, your manager, as you invest into this, because we think we have a good position to understand. And I'll show you why. So the key to AI for me, and I'm not Callum's level of intelligence, but it's not one thing. There are different layers to AI, and this is what we talk about, the foundational layer. And this is the big foundational models that you've all heard about in the press. The big companies that are driving the big returns in NASDAQ, etc. They're all in this phase here. It requires a lot of investment, but this is where the kind of magic is happening right now. Then above that, you have a user interface level, and we're starting to see good companies, and we're aware that AI has the ability to translate things for you right away, or create visual media just by a prompt, a vocal prompt. And then on top of that, you have the applied AI layer. This is where Fund VII is going to invest. Not down at the bottom, we're going to be coming in at the top. And what's interesting about that is some of these companies are not necessarily AI as born as AI companies. They're bringing AI into their processes. They're making themselves more profitable by reducing costs. Maybe they're creating new products more quickly or reaching their customer more quickly. So this, I think, is an important definition. It's not one thing, AI. But what we have seen, this line here is an index we track, and this is a way of valuing SaaS companies, software companies, more traditional software companies. You take their revenue and you say, right, I'll multiply that by maybe 10 times. So if they've got revenue of 10 million, that company's worth 100 million. A simple way of valuing these companies. And actually, you can see during the COVID bubble, it really spiked. But actually, over the last few years, the SaaS index hasn't actually moved that much. And the average is kind of around 7 or 8, if you drew a line through that, maybe a little bit less. But what we're seeing here, of course, these dots are all individual raises by AI companies, the stuff you read about in the news. And you can see, if you draw a kind of a rudimental line through that, you've got this massive shift here. So there's a dissection, if that's the right word, between traditional companies and AI companies. I don't think that's revelatory in any way, but it's interesting for us when we're thinking about that top layer of companies that perhaps aren't AI native. So, capital raised. I think we all see the big capital raises. In the foundational model, this is where all the money's coming in that's being raised. And then on top of that, in the user model and the AI layer, smaller amounts of money being raised compared to that, it's nothing. If we look at CapEx, so this is the money being spent on building these models, and it is huge quantities of money. You need everything from buildings to power to people, and these amounts of money are huge. And again, compared to everything else, this is huge. This is dominating that CapEx. What's interesting about this CapEx is a lot of that money is coming out of the pockets of the big players, of your NVIDIAs, of your Googles. If we look at the revenue at the moment, you can see the revenue is much smaller. So when people talk about bubble, this is what they're worried about. Huge CapEx, huge expenditure with revenue not catching up. Simple as that, right? There's an expectation of what the revenue will be. Will the revenue meet that expectation? But what we're seeing is revenue is growing here, but it's growing even faster in these other layers. Now this at the top, this is where we're going to be aiming, applied AI. And you're starting to see really significant revenue growth here without the required CapEx that's coming in here. This is where we're going to be aiming. So, if you want to work with me here, this is a bit of an interesting example. So we've seen this type of thing before. In the late 19th century, the US built its railway system. And it has similarities to what's going on now with AI. They had to build railways all over the country, and it did end up in a bubble that burst horrifically for investors. So the railway infrastructure, the capital invested was huge. Capital invested at the train manufacturing, so the trains that went on the tracks, was big as well. And then at the top, these other industries invested small amounts. A coal mine may have built a train station near its mine to take coal out. Sorry. Seem to have a... Okay, here we go. What was interesting and what caused the crash was that the revenue for the people that built the infrastructure never really materialized. It came, but it took years and years and years, and the expectation of the revenue was super, super high. So the investors that came in, it never reached their expectations, and then there was a blow up. Everyone wanted to get out. But revenue at this middle layer was huge, without the capex required. The people that made the trains, that then ran on those tracks, the hardware, that was really interesting. And then at the applied layer, the whole frickin' US economy was built on that. So the people that invested at the bottom didn't get the benefit really of the top. They lost their money. But the inherent value they created has been realized for many, many years. Even by 1890, it had boosted GDP by 25% at that point. It opened up the whole Western states, the routes to the Pacific, everything. So I guess my point of what I'm trying to say is that there is perhaps something bubbly going on at the bottom layer, but that's not where we're looking. We're looking at this top layer, this new economy that's being created by the people who are very kindly building this foundational layer for us. So going back to this slide again, reiterating, the revenue we see is going to come here. It's already coming here, but we see it coming at the top level. This is how we are going to be playing the AI wave in Fund VII. That's why I think we're very well placed to do that with and for you. Just one quick word on this. We're also seeing AI, of course, create revenue much more quickly. We've got champions here like Spotify and Shopify. You can see how many years, 1, 2, 3, 4, 5, how many years it took them to get to Series C. You've heard companies like Lovable and Cursor. You know, it's taken them months to get to a Series A at 100 million. It's speeding up the process. So, you know, perhaps that means money will come back, exits will come back more quickly too. So, at that top layer, there's a lot going on, and there's a lot we need to understand. I might just pass off to Callum at this point to maybe break that down a bit.
Yeah, so I think you can see from this slide and what we've been talking about, we're very much in the intelligent computing revolution. So that was the dawn of ChatGPT and everything that is being built on top of those. We see several other waves coming within that. So from this intelligence moving down to the edge, which we start to call autonomous computing. So that's not just robots, but that's things working without connection to the cloud. So if you heard me talk earlier, it was a bit about sort of moving to this inference side, making that cheaper, making that closer to the edge. And then what's happening is AI is accelerating us getting towards the future of computing. So be that quantum, be that other areas that will unlock new potential. So when we think about these areas, they're obviously sort of growing in time. You can see that with that wave there. And there are certain parts of the chain. So what we can unlock now with the technologies that we have, so that's what I call potential. But then there are blockers that sort of sit in the way of that wave. And as you go further in time, the blockers start to dominate over the potential. So we're investing sort of strategically between those. So just to sort of point out a couple of points in the intelligent computing era that we're in now, we've enabled a lot of things. We can start talking about AI agents, efficient manufacturing, but we still do have issues like latency. So our investments in D-Matrix and Multiverse in the last fund are sort of solving these blockers, but I think you're seeing quite a few more happening before we can unlock other areas. And then as you move up, autonomous computing, we need to start augmenting our training data in the blocker side. So we're running out of data to train on. We've used all of the internet, but all of the internet isn't humanity, isn't every situation you see in an autonomous vehicle. So those are sort of some of the areas that I think are blocking there. But what it unlocks, those blockers, is a great amount of potential in things like robotics, in health, we have too much siloed data, and maybe I'll go on to the next slide here. So different themes that we're thinking about are at different stages in that development life cycle. So we'll be investing strategically across those. So health, for example, there's been quite a lot of advances that we've built on. There's a lot of underserved areas that AI can come into, but we still have those siloed data sets. So your Whoop gives you some data, your blood tests give you others. So a tool bringing those together may be an example that unlocks all of this other potential after those come through. Things like space, you're moving maybe slightly further out. We talked about Leo Labs earlier, how they're observing things, making that space economy more useful. But there are things holding back from us using space completely. We need better sensors, we need better communication or arrays on Earth that can then open up all of these things, such as monitoring assets, critical infrastructure on Earth all the time. Then if you look at things like robotics and quantum, there are a number of steps that we have to get through. These are all accruing value in the meantime. So our investment in Q Control in the last fund, they make current quantum computers, quantum systems, as I said earlier, more powerful. So we can do more with a lot less, which provides an unblocker to a lot more of this potential. So we're thinking about these very strategically in each of these themes, that value will accrue at different parts of the stack at different times. I think.
Cool. So maybe you want to introduce yourself more fully this time.
Sure. Hello, everyone. I'm Jonathan. I'm the new addition to the team. I started my career actually in quite a different outfit. I was working for the Rothschild Bank in Paris in the wine team, selling wineries and chateaus, which was an amazing experience. I'm more than happy to talk about wine. And then I spent a few years working for Morgan Stanley and Jefferies in their tech team. And what changed everything for me, we were talking about inflection points yesterday and waves of innovation, is a smartphone. I knew from the day I saw Steve Jobs' presentation launching the iPhone 1 that I wanted to be on the other side of the table and help entrepreneurs developing applications and be in that world. So I joined a firm called DFJ Esprit, basically the investment arm of DFJ, Draper Fisher Jefferson in Europe. We had a very interesting history because we lost a lot of partners down the road, and we were ending, the three of us in 2015, having this crazy idea: how can we build a venture capital model that is patient and permanent at the same time, recognizing that our companies need time to scale, companies stay private longer. And we also saw that there was a clear correlation between the time it takes to sell a company and the multiple you see at exit. So we had the crazy idea of going public, which we did in 2016. More than happy to talk to you tonight about the benefits and the cons, because I think we've been through a very crazy journey. But what it had taught me going public is that DPI is crucial. The financial markets reward you or punish you on your ability to generate cash back and not paper money, especially in this market where we know cash is becoming very scarce. And that's why I want to talk to you about today. It's what is our strategy for generating DPI.
But just before you do
Yep.
that, I mean, it's quite a big deal for us to have Jonathan join us. He's a big name in the market. I appreciate you may not have heard of him, but in our market, it's very big.
You should talk to my wife, Ben.
I was interested. I think it's important for you to explain why, because you could have gone to a lot of big funds, and this is an important part in your life and in your career.
Yeah.
For the next, for this is it for the next part for you, right? So why did you join us? Oh, sorry, I was a little bit.
No.
I think you've.
Well, I thought my last job would be the last one.
Right.
And it wasn't for many reasons. But I think the first reason is, and it's, I'm sorry, it's the honest truth, but it's not a political answer. It's because, and it started here in Marbella, it's because I met Per Roman. And I invested in this great company that we talked about, Ravenpack, back in 2015. I led the Series A at the time, the only investor. And we had to raise more capital, so we talked to the street. And what we were looking for is an investor that obviously can add value. I will talk about that in my session. But also somebody that is a good fit, because it was a very family-owned company going on for 15 years, and this kind of dynamic was very important. And I have to say, in my previous career at Molten, I was doing several things. One of them was being an LP. I backed more than 80 European funds, the best, in my opinion, of the best, whether it's because they were geo-focused, like Partech in France, for instance, or Seedcamp in the UK, or IQ Capital, or Inventures in the Nordics. And what I've realized, backing this early stage fund and then trying to signal investment coming from those funds, was that boards are weak. And I've seen a lot of tourist VCs, especially in a world where money was very, very cheap. You could see all those cohort of young investors starting a fund just because they could. And then I met Per on that board, and I really saw, well, first of all, a deeply genuine good character, but also somebody that cared, and somebody that was willing to run the extra mile, mobilize his network for the company, and look, that was the reason. And then it took a bit of time for me to warm up to the idea of leaving, because I was quite comfortable, let's be honest. But at some point, comfort becomes your enemy. And then I met you guys. And then I saw Fund VI, which you just went through. And I made that point a bit earlier in the previous presentation. And having backed a lot of those funds, it's actually very, very rare to see a fund that is producing so much growth at scale, with this profile of profitability, which made me think, those guys are fishing in the right pond, definitely. So that was the reason behind this move.
Great, thank you.
My pleasure. So let's talk about DPI. This slide is very complicated, but this is on purpose, because I think an exit process and driving DPI is not a simple task. It's not the result of an isolated action or strategy. It's a product of a deliberate process, end-to-end process, putting together many different work streams. So we do drive distribution by managing this coherent parallel workflow of disciplines, which goes from building liquidity right in our investment strategy and executed disciplined exit processes, ensuring basically that DPI is a planned outcome for you, our investors. So how does it work in practice? Well, the first thing is, the first thing is that this firm, our founders, Per, Hugh, and Manish, have been exit focused from day one. I mean, this is an advisory firm helping tech entrepreneurs generate exits. And that mindset was the top priority from the get-go. And I think Bullhound Capital has also been built with that exit first mindset. Always thinking about liquidity and DPI. So liquidity is a core principle of what we do. We bake our liquidity thesis into every investment. That means basically structuring deals always with an eye towards exit, and also actively educated our founders to the process of an exit. We are not passive participants in this market. We actively work on cap tables to create, for instance, secondary opportunities. What happened with Cover Manager, for instance, very early in the cycle of our fund. We track those liquidity options, and we try to act when the window opens if it makes sense for our fund. Also, being M&A bankers at heart and having that in our DNA, we track M&A cycles. We track IPO cycles very closely. We're always ready to act, and I think something that I find quite fascinating since joining you guys is that we run those exit option review at IC very regularly. Is this company exit ready? How can we help it to be exit ready? How can we generate liquidity? And what it means for you, our investors, is basically early and frequent distributions. We really prioritize getting cash back early enough through partial exits, maybe like Cover Manager, and smaller wins. But those wins compound what is, I think, a strong DPI strategy. We believe distributing capital as soon as it's available. We don't overhold assets. We prioritize getting cash back. We don't ignore smaller exits. I mean, this is venture capital. You can't win them all. But you've got to be smart about the timing when you take your liquidity. And again, those small exits, they compound DPI. We leverage also our strategic relationship. This is, again, something that I've seen really clearly on the board of Ravenpack. You know, this strong network of corporate development teams coming from the investment bank. That gives us a real edge that other venture firms don't really have. And we build those relationships in advance of an exit. Again, it's always this mindset of being proactive and positioning our companies for an exit. I think another thing that is very, very important is that there is a rule of thumb that suggests that once an LOI is signed, about 50 to 60%, you have about 50 to 60% of chances that a deal is going to close, meaning 40 to 50% of those LOI never close. And the enemy is alignment. The enemy is not being aligned on a board and not being exit ready. So when we are on boards, we just don't talk only about product market fit. We help balance growth and profitability and capital efficiency with credible exit options. We also help our company thinking early about unit economics and what makes them attractive to buyers. Again, this is very much coming from this DNA, which is deep-rooted in the firm of being exit mindful. We help our founders prepare for liquidity, coaching them, and also on institutional readiness or exit readiness, CFO hires, for instance, when it's required. We've done that very recently with Ravenpack, where one of our vice presidents, Lina, joined the company as a temporary CFO because the company needed this. We help them with reporting standards. What is a good board pack? Because those type of things will be due diligenced in an exit process, and buyers are very mindful of this. We constantly position our portfolio companies in front of potential acquirers. And this is also this really interesting flywheel that I see with the advisory business, where one side of the business feeds the other. And I've honestly never seen that before. Governance for liquidity, I think this is also very, very crucial. We help shape boards to include, when we have to, independent directors who can, or operators who know how to navigate through those M&A and IPO cycles. We love clean cap table. We help a lot with that. You know, it's maximizing our home take value when we can, building our stakes in those companies. And I think the message to you, our LPs, is that this governance discipline means less messy exits and more clean DPI, basically. The last thing I want to say, I made that point before, is networked liquidity. Again, strong relationships with corp dev teams. Oh, sorry. Yeah. And leveraging this really strong network of entrepreneurs, of business executives that we have constantly positioning our companies. So if I would summarize this, I mean, it's really 4 points. Sorry, there you go. Core guiding principles. Liquidity as a discipline baked into our investment thesis. We are very, very focused on getting your cash back as early as possible. When the situation arises, we create those situations. We have the relationship and the networks to make it happen. We don't ignore small exit. And also, we're very transparent with you. If you attend our quarterly calls, we talk about this DPI curve that we have and where we see our funds going. And I think that transparency is really important to inform you of where, you know, your capital is going and how we generate those exits. Thank you.
So then just to round off, we have navigated these big structural shifts in technology, these big cultural shifts before. In the fintech revolution, the mobile revolution, the SaaS revolution, I think we've picked the winners. I think we can do this again in this AI revolution, especially at this applied AI level. And that's why I think you should stick with us, trust us, allocate to us, because I think we're going to do the same thing again. Let me just quickly talk about the team while we're here. So obviously you know Per. We've actually managed to bring Hugh over. You're basically on our side of the business now, right? We've sucked Hugh over from the dark side. Eventually we'll do that to Manish, hopefully too. You know Joachim, you know myself, and Alon and Jonathan is a fantastic hire. It's the first time we've hired somebody at investment partner level. It's a big step. Hopefully you've met Cheryl and Amanda, who are fantastic in our KL office. They're helping our offices access Southeast Asia, actively helping those companies move, open offices there, think about hiring data engineers, etc. They're doing that on the ground as we speak. You've met Carlos. Joya is also new. I don't know if Joya's here. Are you here, Joya? Oh, there she is at the back. Joya has also come from the M&A side of our business. So that is really to bring M&A skills directly into our portfolio companies, help them think about M&A, help them think about exits. Jonathan mentioned that Lena has actually been seconded to Ravenpack. So that's how much value and that's what we put into these companies. We actually will give them our people. She's signed on for them for a year. And then we've added the STEM PhDs with Callum and Irina. You can't get into deep tech without having deep tech academics. We can't pretend we know all these technologies, so you need those people on the team that can do that. Other funds don't have that stuff. And finally, we have the operations team in Luxembourg. Many of you will know Alec. He's a great guy. He's helped you many times. And Guillaume's on the compliance side for us. So I think Per said it earlier. He said, do the same thing, but just do it better every year. So the same core is there, but it's added to. This is a bigger, better organization that I think is doing better funds and better investments. So let's go back to it. The change is real when it comes to AI. Do you want to be in it? That was my dramatic moment, and now the button's not working. Fund VII is now open. Woo! Get your checkbooks out. Does anyone use checkbooks now? It's not very cool. Get your Klarna card out. So the way we're going to do this is the funds have evolved. Most of our fund is now institutional money. Some of them are here. I think in the last fund, about 70% of it is institutional money. The next fund will be. We've already had institutions that have committed to this next fund, but we're not going to leave wonderful people like yourselves behind. So you are cordially invited to our Founders and Friends sleeve. There will be a sleeve for you guys. We do ask you to make your decision by November. So let us know what you want to do. The whole team is available to speak to you about it. We want you on this journey with you. And that is it, everybody. So have a nice lunch. And then the star event of the afternoon is coming after this. Will be Per's keynote. But we're all available. But thank you so much for coming. And let's have a great time.